Hello, welcome back to my channel. Today we are talking about stock market terminology and why you should know them. Before we dive into it, if you're new here, make sure you guys like, comment, share, and subscribe to this video. See you in the next video, and happy investing.
Ever wondered what these stock market terms actually mean? Well, you're in the right place. Today, we're going to decipher the language of the financial world, making it accessible and easy to understand. We'll be covering a range of terms that, once understood, could be your key to unlocking the mysteries of the stock market. We'll start with the basics. What is a stock, and what is a share? From there, we'll move on to equity and dividend. We'll also delve into the exciting world of initial public offerings, or IPOs. Next, we'll take a look at the difference between a bull market and a bear market. Then we'll tackle volatility, market cap, and finally, blue chip stocks. Each term will be explained in plain English, cutting through the jargon and making the world of investing a little less intimidating. So buckle up and get ready for a financial lingo ride. Ready or not, here comes your first term. First up, stock and share. Are they the same? Let's wade into this, shall we? A stock is essentially the capital raised by a business through the issue of shares. When you buy a stock, it signifies that you've bought a piece of that company's assets and earnings. You're a part owner, if you will. But what about a share? Well, a share is a single unit of stock. Think about it as a slice of the proverbial pie. When a company has 1 million shares of stock outstanding and you buy one, you own a 1/1,000,000th part of that company. Stocks and shares are often used interchangeably, but there's a subtle difference. When we talk about stocks, we're referring to the concept of ownership in a company. But when we talk about shares, we're referring to specific units of that ownership. So remember, owning a share means you own a piece of a company's stock. Next on the list, we have equity and dividend. Let's break them down. Imagine you've bought a piece of the financial pie, a company's stock. Now, after paying off all its debts and liabilities, whatever remains of that pie is your equity. It's the true measure of what you own in a company. Now let's talk about dividends. Imagine you're at a grand feast, hosted by the company you've invested in. As a token of appreciation for your investment, the company serves you a slice of its profit pie. That slice is your dividend. A company can choose to distribute dividends in the form of cash or additional shares. So, in the grand scheme of the stock market, equity represents your piece of the pie, your ownership stake in a company. And dividends? They're the sweet rewards you receive for being a part of the company's journey. In essence, equity is what you truly own, and dividends are your rewards as an investor. Ever heard of the term IPO and wondered what it stands for? Well, let's unravel this mystery. IPO stands for Initial Public Offering. It's essentially the grand opening of a private company to the public. Imagine it as the red carpet debut of a company in the stock market world. The company sells its stocks to the general public, turning from a private entity to a public one. It's like a company's coming-of-age party in the financial realm. So, an IPO is basically a company's debut on the stock market stage. Bull market, bear market. No, we're not talking about wildlife here. We're talking about important terms in the stock market. So let's dive in. A bull market refers to a period of increasing stock prices typically characterized by optimism, investor confidence, and expectations that strong results should continue. It's like a charging bull, always moving forward, pushing stock prices higher and higher. On the other side of the spectrum, we have the bear market. This is a period of falling stock prices, often by 20% or more, usually over a period of at least 2 months. It's named after a bear swiping downwards, symbolizing the decline in stock prices. During this time, pessimism and negative sentiment generally pervade the market, causing investors to expect further declines. So, you could say in a bull market, investors are optimistic. In a bear market, not so much. Now, aren't these terms less intimidating when you get to know them? Finally, let's tackle volatility, market cap, and blue chip stocks. These are terms you'll often encounter as you navigate the world of investing. Let's kick off with volatility. Now, volatility is a bit like a roller coaster ride. It's the degree of variation in a trading price series over time. Imagine a serene boat ride on a calm lake where the water is smooth and the ride is steady. That's a low volatility scenario. But now, picture a wild whitewater rafting adventure where the water is choppy and the ride is unpredictable. That's high volatility. In the world of stocks, high volatility means the price of a stock can change dramatically over a short time period in either direction. It indicates a higher risk, but also the potential for significant gains or losses. Next up is market cap, short for market capitalization. Think of it as the total market value of a company's outstanding shares of stock. It's like putting a price tag on a company. To calculate it, you simply multiply the current market price of one share by the total number of shares outstanding. It's an essential tool for investors as it helps determine a company's size and its potential for growth or risk. Last but not least, we have blue chip stocks. Now these aren't chips you can snack on, rather, they are shares in large, nationally recognized companies with a history of reliable, stable growth. They're named after the highest value poker chip, the blue one. Blue chip stocks are considered a safe bet for investors because they tend to weather market downturns better than smaller, less established companies. They're the powerhouses of the stock market, the ones that have stood the test of time. So in a nutshell, volatility shows market mood swings, market cap tells a company's worth, and blue chip stocks are the big, reliable players. These terms are not just jargon, they're vital tools to understand and navigate the investment landscape. Armed with this knowledge, you're well on your way to becoming a savvy investor. Now that we've covered all these terms, let's do a quick recap. First off, stock and share are essentially the same thing. When you own a share, you own a piece of a company's stock. It's like having a slice of a much larger pie. Then we have equity, which is the value of these shares. Think of it as your personal stake in a company. The more equity you have, the bigger your piece of the pie. Dividends represent your share of the company's profits. If a company you've invested in is doing well, they might distribute a portion of their earnings back to you, the shareholder. Next up is IPO, or initial public offering. This is when a company decides to go public, offering shares of its stock to the general public for the first time. We also talked about bull and bear markets. A bull market is when things are looking up with prices generally rising. On the flip side, a bear market is when prices are falling and the outlook is a bit more gloomy. Volatility refers to the degree of variation in a stock's price. High volatility can mean big swings in price, either up or down. Market cap, short for market capitalization, is the total value of all a company's shares of stock. Finally, blue chip stocks refer to shares in large, well-established companies with a history of reliable performance. And there you have it, a simple guide to understanding stock market lingo. Now go impress your friends with your newfound knowledge.